Short selling. It is a bet that a stock will fall. You borrow shares, sell them, wait for the price to drop, buy them back cheaper, return them, keep the profit. Hedge funds do this constantly. In 2020, GameStop was heavily shorted, over 100% of shares. Hedge funds were certain GameStop would die. Then Reddit discovered this. They realized, if everyone buys and holds, short sellers must buy to cover. This drives the price up. More shorts cover. Price goes higher. A short squeeze. In January 2021, it happened. GameStop went from $20 to $483. Short sellers lost over $20 billion. Melvin Capital, a major hedge fund, lost 53% in January. It never recovered. It closed in 2022. This is the story of the short squeeze, the strategy that destroyed hedge funds, and the triumph of retail investors. Let us rewind to 1984. GameStop is founded as Babbage's, a small software retailer in Dallas, Texas. Over decades, it grows. It becomes GameStop in 1999. It specializes in video games, new games, used games, trade-ins. By the 2000s, GameStop is everywhere. Thousands of stores, in malls, shopping centers. Gamers love it. But by 2010, the industry is changing. Digital downloads, Steam, PlayStation Store, Xbox Live. Gamers buy games online. They do not need physical stores. GameStop's business model is dying. By 2019, GameStop is in trouble. Revenue is declining. Stores are closing. The stock price is falling. From $60 in 2013 to $4 in 2019. Analysts are bearish. GameStop is the next blockbuster. It will go bankrupt. Hedge funds see opportunity. They short GameStop, betting it will collapse. By late 2020, GameStop is one of the most heavily shorted stocks in America. Short interest exceeds 100% of available shares. This means hedge funds borrowed more shares than exist. It is aggressive, risky, but they are confident. GameStop is dying. Then COVID hits. March 2020. The economy shuts down. Retail collapses. GameStop closes stores. The stock falls to $2.85. Hedge funds are winning. They are making billions. But something unexpected happens. GameStop does not die. In June 2020, GameStop appoints new board members. Ryan Cohen, founder of Chewy, the pet supplies company, buys a stake. He has a vision. Transform GameStop. Make it digital. E-commerce. Cohen is respected. Young. Innovative. His involvement changes the narrative. Retail investors notice. Maybe GameStop is not dying. Maybe it can transform. Like Netflix transformed from DVDs to streaming. Maybe Cohen can save GameStop. On Reddit, a subreddit called Wall Street Bets starts discussing GameStop. Users analyze the stock. They see the heavy short interest. They see Cohen's involvement. They see potential. One user stands out. Keith Gill. Username, Roaring Kitty. He posts detailed analysis. He invests $53,000 in GameStop. His entire savings. In June 2020, GameStop is trading at $4. People mock him. You are crazy. GameStop is dead. Keith does not care. He believes. He holds. Keith Gill is not a hedge fund manager. He is not a Wall Street trader. He is a 34-year-old financial analyst at Mass Mutual, an insurance company. He lives in Wilmington, Massachusetts. He has a wife and a young daughter. He is ordinary, normal, but he loves stocks. In his spare time, Keith posts on Reddit, Wall Street Bets, and on YouTube. As Roaring Kitty, he analyzes stocks. He shares his portfolio. He is transparent, honest. People like him. In June 2020, Keith discovers GameStop. He researches the company. He reads financial statements. He watches industry trends. He analyzes the short interest. He sees opportunity. GameStop is trading at $4. The market cap is $280 million, but GameStop has over $500 million in cash. No debt, thousands of stores, millions of customers, a loyal base, and Ryan Cohen is involved. Cohen transformed Chewy into a $3.5 billion company. Maybe he can do the same with GameStop. Keith runs the numbers. He values GameStop at $20 to $25 per share, 5 to 6 times the current price. He decides to invest. He puts $53,000 into GameStop. His entire savings, call options, shares, everything, he posts on Wall Street Bets. He shares screenshots, his position, his reasoning. People are skeptical. GameStop is dying. You are throwing money away. Keith does not argue. He posts updates, weekly, sometimes daily, showing his gains, his losses, his conviction. Months pass. GameStop trades sideways. $4, $5. Keith holds. His wife is nervous. Are you sure about this? Keith is sure. By September 2020, Keith is down. His $53,000 is worth $35,000. He posts the loss. Still holding. People mock him. Diamond hands to zero. Keith ignores them. Then in October, Ryan Cohen officially joins GameStop's board. He buys a larger stake. He pushes for e-commerce transformation. The stock starts rising. $5, $8, $10. Keith's position grows. $35,000 becomes $60,000. Then $100,000. By December 2020, Keith's investment is worth over $500,000. People on Wall Street bets notice. Roaring Kitty was right. His posts get thousands of upvotes. He becomes a legend in the community, but Keith does not sell. I like the stock. He holds. He believes in GameStop. He believes in Cohen. He believes in the squeeze potential. The short interest is still over 100%. If enough people buy and hold, the shorts will be forced to cover. The price will explode. Keith's conviction inspires others. Thousands on Wall Street bets start buying GameStop. They hold, they do not sell. They create memes. Diamond hands. To the moon. We like the stock. A movement is born. By early January 2021, GameStop is trading at $20. Keith's $53,000 is worth over $2 million. People are amazed. But Keith still does not sell. He holds. The squeeze is coming. Wall Street Bets is a subreddit, founded in 2012. It is a place for retail investors to discuss stocks, share trades, celebrate gains, mock losses. The culture is irreverent. Memes, jokes, self-deprecation. Users call themselves apes and retards. It is crude, chaotic, but authentic. By 2020, Wall Street Bets has over 1 million members, mostly young, mostly male. Many are new to investing. The pandemic brought them stimulus checks, free time, commission-free trading apps like Robinhood. They want to make money, get rich, beat the system. Wall Street Bets is not like traditional investing forums. There are no suits, no jargon, no pretense. It is raw, real. Users post their wins, their losses, their YOLO trades. You only live once. High risk, high reward. Sometimes it works. Often it does not, but it is exciting. In late 2020, users start discussing GameStop. The heavy short interest catches attention. Over 100%. This is rare, dangerous for short sellers. If the stock rises, they must buy to cover. This pushes the price higher. A feedback loop. A short squeeze, users like Keith Gill, Roaring Kitty, post detailed analysis. Others join. They buy GameStop. They hold. They encourage each other. Diamond hands. Do not sell. The community bonds. It is not just about money. It is about solidarity. Us versus them. Retail versus Wall Street. By early January 2021, Wall Street Bets has over 2 million members. GameStop is the most discussed stock. Posts multiply. Memes flood the forum. Images of rockets. To the moon. Elon Musk tweets. Chamath Palihapitiya tweets. GameStop is everywhere. The momentum builds. January 4th, GameStop closes at $17. January 11th, $20. January 13th, $31. January 19th, $39. Each day, the price climbs. Short sellers are bleeding, but they do not cover. They double down. They short more. They are confident GameStop will crash. Wall Street Bets users see this. They buy more. They hold tighter. The squeeze is happening. January 22nd, $65. January 25th, $76. The price is exploding. Short sellers panic. Hedge funds are trapped. The media notices. CNBC, Bloomberg, The Wall Street Journal. Reddit traders are squeezing GameStop. Wall Street is confused, angry. Who are these people? Why are they doing this? Do they not know GameStop is worthless? But Wall Street Bets does not care about fundamentals. They care about the squeeze. They care about beating hedge funds. They care about making money. And they care about each other. It is a movement, a revolution. David versus Goliath. By January 27th, GameStop hits $347. Keith Gill's $53,000 is worth over $48 million. He still does not sell. Neither do millions of others. They hold. Diamond hands. The squeeze is reaching its peak. Then Wall Street strikes back. Melvin Capital is a hedge fund, founded in 2014 by Gabe Plotkin. It manages $13 billion. Plotkin is respected, A protege of Steve Cohen, the billionaire investor, Melvin focuses on short selling, finding overvalued stocks, betting they will fall. It is profitable. Until GameStop. By late 2020, Melvin has a massive short position in GameStop. Billions of dollars. Plotkin is certain GameStop will collapse. It is a dying retailer, losing money. Closing stores. The fundamentals are terrible. Shorting it is obvious, safe. But in January 2021, GameStop starts rising. $10, $20, $30. Melvin is losing money. Plotkin is not worried. It is a temporary spike. Retail traders do not know what they are doing. The stock will crash, but it does not crash. It keeps rising. 40, 60, 100. Melvin's losses mount. Millions become hundreds of millions. Plotkin tries to cover some shorts, but covering means buying. Buying pushes the price higher. It is a trap. By January 25th, GameStop is at $150. Melvin has lost over $3 billion. The fund is down 53% for the month. It is a disaster. Melvin is facing margin calls. Lenders want their money. The fund is at risk of collapse. Plotkin calls for help. He contacts Steve Cohen, his mentor. He contacts Ken Griffin, founder of Citadel, another massive hedge fund. On January 25th, Cohen and Griffin bail out Melvin. They inject $2.75 billion. It is the largest hedge fund bailout in history. The media reports it. Melvin Capital receives bailout after GameStop losses. Wall Street Bets celebrates. They heard a hedge fund. They forced a bailout. They are winning, but Plotkin does not give up. With the bailout, Melvin continues. They try to wait out the squeeze. They hope retail traders lose interest. They hope GameStop crashes. But on January 27th, GameStop hits $347. Melvin's losses exceed 53%. The bailout is not enough. The fund is hemorrhaging. Plotkin covers more shorts, buying billions of dollars of GameStop, driving the price even higher. By the end of January, Melvin has lost over $7 billion on GameStop. The fund is decimated. It never recovers. In May 2022, Gabe Plotkin announces Melvin Capital is closing. After 8 years, the fund is dead. Killed by GameStop. Killed by retail traders. Killed by the squeeze. Melvin is not the only casualty. Other hedge funds shorting GameStop also lose billions. Maple Lane Capital, Light Street Capital, D1 Capital. The total losses exceed $20 billion. It is the most expensive short squeeze in history. Wall Street is shocked. How did retail traders on Reddit destroy professional hedge funds? How did they win? It is supposed to be impossible. Wall Street has the information, the money, the power. Retail traders are supposed to lose, but they did not lose. They won. And Wall Street is furious. January 28, 2021. GameStop opens at $265. Pre-market, it hit $513. Retail traders are ecstatic. The squeeze is working. Hedge funds are collapsing. Victory is near. Then at 9 a.m. Eastern, Robinhood makes an announcement. Due to market volatility, we are restricting transactions for GameStop, AMC, and other securities. Users can sell, but they cannot buy. Only sell. The reaction is immediate. Fury, confusion, betrayal. What? Why? Users flood social media, Reddit, Twitter. Robinhood is protecting hedge funds. They stopped us from winning. This is market manipulation. The price crashes. With no buying pressure, only selling, GameStop plummets from $490 to $112. Billions of dollars in retail wealth evaporate. Users are devastated. They were winning. Then Robinhood changed the rules. Robinhood's CEO, Vlad Tenev, issues a statement. We made this decision to protect our customers and the market. It is a regulatory issue. We had no choice. He claims Robinhood faced a capital requirement from clearinghouses. They needed to restrict trading to meet the requirement. But users do not believe him. They think Robinhood is protecting Wall Street, protecting hedge funds. Citadel, the market maker and hedge fund, pays Robinhood for order flow. Citadel also bailed out Melvin Capital. The connections are clear. Citadel wanted the GameStop squeeze to stop. Robinhood obliged. Lawsuits are filed. Dozens of class action suits, accusing Robinhood of market manipulation, of collusion, of betraying retail investors. Robinhood's reputation is destroyed. The app that promised to democratize finance just protected the rich. Congress announces hearings. Representative Alexandria Ocasio-Cortez tweets, "This is unacceptable." Senator Ted Cruz agrees. For once, both sides of the political aisle unite against Robinhood for retail investors, but the damage is done. January 28th is the peak. GameStop never reaches $500 again. It falls over the following weeks. Retail traders lose billions, not because they sold, but because they could not buy. Robinhood stopped them. Years later, investigations reveal the truth. Emails show Citadel and Robinhood communicated during the squeeze. Robinhood restricted trading not just for capital requirements, but to protect its relationship with Citadel. The SEC fines Robinhood, but the fine is small. $70 million. A slap on the wrist. January 28th becomes a symbol of a rigged system, of Wall Street protecting itself, of retail investors fighting but losing because the rules change when they start winning. But it also becomes a rallying cry. The fight is not over. The movement continues. February 18th, 2021. The House Financial Services Committee holds a hearing. GameStop? Who wins and loses when short sellers, social media, and retail investors collide? 5 witnesses testify. Gabe Plotkin, Melvin Capital. Vlad Tanev, Robinhood. Ken Griffin, Citadel. Steve Huffman, Reddit. And Keith Gill, Roaring Kitty. It is unprecedented. A retail investor testifying before Congress. Keith Gill is not a CEO, not a billionaire. He is an ordinary person, but he is the face of the GameStop movement. Congress wants to hear from him. Keith appears via video. He is in his basement, the same place he streamed on YouTube. He wears a red headband. Casual, relaxed. He is not intimidated. Representatives question him. Did you manipulate the market? Did you coordinate with others? Keith answers calmly. No, I simply like the stock. I did my research. I invested. I shared my analysis. That is all. Representative Juan Vargas asks, are you still holding GameStop? Keith smiles. Yes, I like the stock. The room erupts. Applause from some. Shock from others. Keith just told Congress he is still holding. Despite the crash, despite the losses, he believes. The hearing also focuses on Robinhood. Representatives grill Vlad Tanev. Why did you restrict trading? Tanev repeats his explanation. Capital requirements. Clearinghouse demands. He denies collusion with Citadel. Ken Griffin, Citadel's CEO, testifies. He denies pressuring Robinhood. We did not ask them to restrict trading. They made that decision independently. But emails later show Citadel and Robinhood communicated multiple times during the squeeze. The denials ring hollow. Gabe Plotkin, Melvin Capital, admits the fund lost billions. We underestimated the situation. He denies Melvin covered all its shorts on January 27th. But evidence suggests otherwise. Melvin likely closed most positions, driving GameStop's price to its peak. The hearing does not result in major action. No charges, no significant regulations. But it is symbolic. For the first time, retail investors have a voice. Keith Gill, an ordinary person, faced Congress, and he did not back down. I like the stock becomes a rallying cry. A meme, a symbol of retail investor defiance. Keith Gill becomes a folk hero. After January 2021, GameStop's stock eventually falls. From $483, it drops to $40 by February. Then it stabilizes. It trades between $150 and $300 through 2021 and 2022. Still far above the pre-squeeze price of $5. Why does it stay elevated? Several reasons. First, retail investors hold. Millions bought during the squeeze. Many refuse to sell. Diamond hands. They believe in the company. Or they believe in the movement. Second, Ryan Cohen transforms GameStop. He becomes chairman in June 2021. He hires executives from Amazon and Chewy. He focuses on e-commerce, digital transformation, NFTs, gaming culture. The company's strategy changes. It is no longer just a retail store. It is a technology company, or trying to be. Third, short interest remains. Not as high as 100%, but significant. Around 20%. Retail traders believe another squeeze is possible. They keep buying, waiting. GameStop raises capital. In April and June 2021, it issues new shares. It raises nearly $2 billion. The company uses this to pay off debt, invest in technology, transform the business. By 2023, GameStop is profitable in some quarters. Revenue is declining. But the company is not dying. It is stable, transforming. Whether it succeeds long-term is unclear, but it survives. Thanks to the squeeze, thanks to retail investors, Keith Gill, Roaring Kitty, disappears from public view after the congressional hearing. His final post on Wall Street Bets shows his position. He holds, he does not sell. His $53,000 is worth over $30 million by the peak. He likely cashed out some, but how much is unknown. He becomes a legend. The man who saw the squeeze, who held, who inspired millions. Wall Street Bets remains active. Over 13 million members by 2023. It continues to discuss stocks, memes, trades. But nothing matches the GameStop phenomenon. It was a unique moment. A perfect storm. Heavy short interest. Retail coordination. Media attention. It may never happen again, but the legacy endures. Retail investors have power. When united, they can move markets. They can challenge Wall Street. They can win. The system is not as rigged as it seems. Or maybe it is. But for one brief moment, the little guy won. GameStop teaches several lessons. Some about markets, some about human behavior, some about power. First, short squeezes are real. Hedge funds underestimated the risk. They shorted GameStop over 100%. They assumed retail traders were dumb, disorganized, weak. They were wrong. Retail traders united. They bought, they held, they created the squeeze. Hedge funds lost billions. The lesson: do not underestimate your opponent. Second, social media changes markets. Before the internet, retail investors were isolated. They bought what analysts recommended. They traded alone. Now they coordinate. Reddit, Twitter, Discord. Millions can unite instantly. Share ideas, strategies. This creates power. Wall Street must adapt or lose. Third, commission-free trading matters. Apps like Robinhood democratized investing. No fees, anyone can trade. This empowers retail investors, but it also creates risk. Many do not understand what they are doing. They chase memes. They YOLO their savings. Some win, many lose. Democratization is good, but education is also necessary. Fourth, the system protects the powerful. When retail investors started winning, the rules changed. Robinhood restricted trading, protecting hedge funds, protecting Wall Street. This reveals the truth. The game is rigged, not completely. Retail can win, but only until they threaten the establishment. Then the establishment fights back. Fifth, fundamentals matter, eventually. GameStop squeezed from $5 to $483. But it fell. Why? Because the fundamentals did not support $483. GameStop is not worth that. It is worth 20, 50, maybe, but not 500. Squeezes are temporary. Fundamentals are permanent. You can win a battle. But if the company is bad, you lose the war. Sixth, emotion drives markets. GameStop was not just about money. It was about revenge. About sticking it to Wall Street. About solidarity. Apes together strong. Retail investors held even when it was irrational. Even when they were losing. Because it was not about profit. It was about the fight. This is powerful, but dangerous. Emotion can inspire, but it can also destroy wealth. Finally, retail investors matter. For decades, Wall Street ignored retail. They were insignificant, small, powerless. GameStop changed that. Retail moved a stock from $5 to $500. They destroyed hedge funds. They dominated the news. Wall Street can no longer ignore retail. They are a force, unpredictable, chaotic, but real. GameStop is a case study. In markets, in power, in coordination. It is taught in business schools, analyzed by economists, debated by regulators. It will be studied for decades. Let us break down the short squeeze. How did GameStop go from $20 to $483? Step 1. Heavy short interest. By December 2020, GameStop's short interest is 140%. This means short sellers borrowed 140 shares for every 100 shares that exist. How some shares are lent multiple times. It is legal, but risky. Step 2. Retail buying. In January 2021, millions of retail investors buy GameStop. They buy shares. They buy call options. Demand surges. The price rises. $20, $30, $40. Step 3. Short sellers start losing. They borrowed shares at $5. Now the price is $40. They are underwater. They have two choices: hold and hope the price falls, or cover, buy back shares, and take the loss. Step 4. Covering drives the price higher. When short sellers buy to cover, they add buying pressure. This pushes the price up, $60, $80, $100. More short sellers are forced to cover. More buying, $150, $200. It is a feedback loop. Step 5. Gamma squeeze. Call options amplify the squeeze. When retail buys call options, market makers hedge by buying shares. If the price rises, market makers must buy more shares to stay hedged. This adds even more buying pressure. GameStop's price explodes. $300, $400, $483. Step 6. The peak. At $483, GameStop is worth over $33 billion. For a company losing money, it is insane, unsustainable. But momentum carries it. Short sellers are capitulating. Retail is euphoric. The media is obsessed. Step 7, the crash. Robinhood restricts trading. Buying pressure disappears. Only selling remains. The price crashes. 400 to 100. Short sellers who survived cover. Retail traders who bought at 400 are trapped. Step 8, stabilization. GameStop settles around $150 to $200. Still far above $5. Why? Retail holds. Cohen transforms the company. Short interest remains. The squeeze is over, but the elevated price persists. This is how a short squeeze works. It requires heavy short interest, coordinated buying, and a catalyst. GameStop had all three. Keith Gill, Roaring Kitty, invested $53,000. At the peak, worth over $48 million. He likely cashed out some, probably still holds some. His exact profit is unknown, but he won big early retail investors. Those who bought GameStop in 2020 at $5 and sold at $300 made life-changing money. Thousands became millionaires. Some paid off student loans. Some bought houses. Some quit their jobs. Ryan Cohen. He bought into GameStop before the squeeze. His stake was worth billions at the peak. Even now, GameStop's elevated price makes Cohen very wealthy. He also becomes chairman. Gains influence. Gains a platform. Social media influencers. Roaring Kitty gains millions of followers. Others on YouTube, Twitter, TikTok gain audiences. They monetize. Merchandise, ads, subscriptions. The squeeze makes them famous. And rich losers, Melvin Capital. Lost over $7 billion. Closed in 2022. Gabe Plotkin's reputation is destroyed. He becomes a symbol of hedge fund hubris. Other short sellers. Maple Lane, Light Street, D1 Capital, and others lose billions. Some close positions. Some close funds. The total losses exceed $20 billion. Late retail investors. Those who bought GameStop at $400 and held as it fell to $40 lost everything. Thousands lost their savings. Their dreams. They were told diamond hands. They held. They lost. Robinhood. The company's reputation is destroyed. Lawsuits, fines, congressional hearings. Robinhood's IPO in July 2021 is tainted. The stock falls. Vlad Tenev becomes one of the most hated CEOs in America. Wall Street's credibility. The squeeze exposes the system's flaws. The rigging. The double standards. Trust in Wall Street declines. Retail investors feel betrayed. They do not forget. GameStop is not just a financial event. It is a cultural phenomenon. It dominates the news. Social media, entertainment, memes flood the internet. Diamond hands, hands made of diamonds. Do not sell. Hold. To the moon. Rockets. GameStop going to the moon. Apes together strong. From Planet of the Apes, retail traders uniting, celebrities join. Elon Musk tweets GameStonk. It goes viral. The stock jumps. Chamath Palihapitiya, a billionaire investor, buys GameStop call options live on CNBC. He donates the profits to charity. For the people. Wall Street reacts with contempt. Analysts call retail traders stupid. CNBC hosts mock them.
They do not understand markets, but retail does not care.
They wear the insults as badges of honor. Yes, we are dumb. But we are winning. Hollywood notices. In 2023, a movie is released. Dumb Money. Directed by Craig Gillespie. It tells the GameStop story. Keith Gill is the protagonist. Played by Paul Dano. The movie celebrates retail investors. Vilifies hedge funds. It is not a blockbuster. But it is significant. Hollywood acknowledges the event. Immortalizes it. Books are written. The Antisocial Network by Ben Mesrich. Detailing the squeeze, the players, the drama. It becomes a bestseller. GameStop stores sell GameStop stock merchandise, T-shirts, diamond hands. To the moon. Retail investors buy them. Proudly. The legacy is complex. Some view GameStop as a triumph, retail investors beating Wall Street. A revolution. Others view it as a cautionary tale. Greed, delusion. Millions lost money, but everyone agrees. GameStop changed investing. Retail investors have power now. Wall Street knows it. The next GameStop is inevitable. Maybe AMC, maybe another stock. The template is set. Retail can coordinate. They can squeeze. They can win. Wall Street adapts. Hedge funds are more careful shorting. They watch social media. Monitor Wall Street bets. They know retail is watching, coordinating, waiting. The game has changed. Forever. After GameStop, regulators investigate. The SEC, FINRA, Congress. They ask, did anything illegal happen? Should rules change? The SEC releases a report in October 2021. Key findings. The GameStop squeeze was driven by retail buying, not by short sellers covering. This surprises many. It means retail demand, not the squeeze, drove most of the price increase. Short covering happened, but it was not the main driver. The report also finds no evidence of coordination to manipulate the market. Wall Street Bets users discussing GameStop is legal. Free speech. Sharing investment ideas is not manipulation. Hedge funds do it. Retail can too. However, the report highlights concerns. Payment for order flow. Robinhood sends orders to Citadel. Citadel pays Robinhood. This creates conflicts of interest. The SEC suggests reviewing this practice. The report also questions gamification. Apps like Robinhood use confetti, push notifications, encouraging trading. Is this responsible or manipulative? The SEC suggests rules, but no major regulations pass. Congress holds hearings. Both parties agree something is wrong, but they cannot agree on solutions. Republicans want free markets. Democrats want protections. Nothing happens. Robinhood is fined $70 million for misleading customers. For the trading restrictions, it is the largest FINRA fine ever. But for Robinhood, a company worth billions, it is a slap on the wrist. Short selling remains legal. Unrestricted. Hedge funds can still short over 100%. The rules do not change. Payment for order flow continues. Robinhood still sends orders to Citadel. The conflict remains. In short, GameStop changed culture, but it did not change regulations. Wall Street adapts, but the system remains. Some argue this is good. Free markets work. Others argue it is bad. The game is still rigged. The debate continues. Today, GameStop trades around $20 to $30, far above the pre-squeeze $5, but far below the peak of $483. The company is transforming. E-commerce, digital, NFTs. Ryan Cohen leads. Whether it succeeds is unclear. Keith Gill, Roaring Kitty, is silent. He has not posted since April 2021. His final update showed he still held. Did he sell? Did he hold? Nobody knows. He is a legend. A mystery Wall Street Bets continues. Over 13 million members. It discusses stocks, crypto, memes, but nothing matches GameStop. Some try, AMC, Bed Bath & Beyond. None replicate the magic. GameStop was unique. Melvin Capital is dead. Closed in 2022. Gabe Plotkin manages his own money now. Quietly, his reputation is ruined. Robinhood struggles. The IPO in 2021 disappoints. The stock falls. Trust is gone. Competitors grow. Robinhood's future is uncertain. Citadel thrives. Ken Griffin's firm makes billions. The scandal does not hurt them. They are too big, too powerful. Was GameStop a revolution? Or just a moment? It depends who you ask. For retail investors, it was a revolution. Proof they have power. Proof they can win. Proof the system can be challenged. They will never forget. They will try again. For Wall Street, it was a moment. A blip. An anomaly. They adapted. They moved on. Hedge funds are more careful now. But the game continues. They still win. Most of the time, for regulators, it was a warning. Markets are changing. Retail is powerful. Social media is real. They watch now, monitor, but they do not act. Not yet. GameStop's legacy is dual, a triumph and a tragedy, a revolution and a cautionary tale. It is the story of the little guy fighting back, sometimes winning, sometimes losing, but always fighting, and the fight continues.